Asian stock markets suffered decent losses on Wednesday after Donald Trump said that he may delay a trade deal with China till after the 2020 U.S. presidential election. Probably it was yet another attempt to regain the upper hand in the negotiations, but the statement did put a significant pressure on the regional shares as expectations of a Phase 1 deal declined substantially. As a result, Japan's Nikkei 225 fell 1.05%. The additional pressure came from a plunge of the index heavyweight fast retailing by over 5%. Australia's S&P ASX 200 declined 1.58%. The index was uninspired by the report, which showed that the Australian economy grew 1.7% on a seasonally adjusted basis year-on-year in the third quarter, with the rate of growth remaining well below the long-term average. In China, the Shanghai Composite was down 0.23%, while Hong Kong's Hang Seng Index declined 1.16%. South Korea's Kospi finished 0.73% lower, and overall the MSCI Asia ex-Japan Index shed 0.84% by the end of the session. Meanwhile, European stocks were higher on Wednesday as investor sentiment over the prospect of a trade deal improved after Bloomberg reported that the U.S. and China were moving closer to striking an agreement on the amount of tariffs they would be rolled back in a Phase 1 trade deal. As for the data, the Eurozone business activity held steady in the last month, with the final reading of IHS Markit's composite PMI coming in at 50.6, above the 50 mark, separating growth from contraction. Against this backdrop, London's FTSE 100 was 0.4% higher on this session. Germany's CAC 30 rallied 1.2%, while France's CAC 40 rose 1.3%. The Stoxx Europe 600 rose 1.1% to 402.33 after 4 straight bearish sessions. The reports that Beijing and Washington were making progress toward a Phase 1 trade deal inspired American investors as well. The 3 major Wall Street indices, the Dow Jones, the Nasdaq Composite, and the S&P 500, gained 0.7% on average off earlier highs. In currencies, the Euro-US dollar made a false break above the 1.11 handle. After a short-lived rally to one-month highs at around 1.1160, the euro retreated back by nearly 100 pips and settled marginally above the 100 DMA, which continues to serve as support. The renewed trade optimism, coupled with another dismal economic report from the United States, fueled aggressive buying in the common currency, but as the euro remains fundamentally weak, traders opted to take profit at more attractive levels, which resulted in a correction. The U.S. ISM non-manufacturing PMI for November came in at 53.9, half a point below the consensus expectation. Earlier, the U.S. released disappointing figures on the ISM manufacturing PMI and ADP employment. Meanwhile, the USD-Japanese yen pair dipped to fresh 2-week lows near 108.40, but as global risk sentiment started to rebound, the dollar turned decently higher and faced resistance just below the 109.0 handle. By the end of the day, the pair settled around the 200 DMA, with weaker than expected U.S. services PMI failing to stir the buyers as the safe haven yen demand turned sour. Despite the local recovery, the USD-Japanese yen is still vulnerable to further losses as long as it stays below the 109 figure. As for commodities, Brent crude rallied strongly from the 100 DMA around $61 up to the $63.50 area due to a positive industry report from the U.S. According to the EIA data, commercial crude inventories decreased by 4.9 million barrels from the previous week. The result was much better than expected and more positive than the figures from the API. The futures posted the largest intraday gains since September as the U.S. crude inventories declined for the first time in 6 weeks. Also, investors continued positioning ahead of the crucial meeting of the members of the Organization of the Petroleum Exporting Countries on Thursday and OPEC Plus gathering scheduled for Friday. Traders expect that the producers will announce a decision and extend and deepen output cuts has grown. Besides, there are reports that the Saudis have threatened to boost their own production because other members don't fully comply with current output reductions. That is all for today. Thank you so much for watching. Please click subscribe to always be in touch with the latest market news.